We've learned about how we measure poverty in the United States, including flaws in the official measure and some proposed alternatives. We've also seen that income inequality has risen markedly in the United States since the 1970s. Official poverty rates, in contrast, have barely changed since the 1970s. In the next 3 modules, we'll talk about why poverty rates have been so constant in the U.S., including underlying factors that have kept poverty rates from falling, and a number of measurement and related issues that complicate the story beyond that told by simple official measures. This picture shows the number of poor individuals in the United States and the poverty rate, which is just the number of poor divided by the overall population. The number of poor individuals in the U.S., after falling in the 1960s, has gradually trended up over time, with some ups and downs corresponding to economic downturns. More informative for most purposes is the poverty rate, which normalizes this number for the growing U.S. population. As you can see, the U.S. official poverty rate was at 15% in the late 1960s, and in 2010, following some ups and downs, was again at 15%. The poverty rate stayed very close to 15% until 2015, when it fell to roughly 13.5%. The constancy of the poverty rate is surprising for a number of reasons. First, the 1960s were the beginning of what was known as the War on Poverty, in which many safety net programs, policies aimed at providing a variety of forms of assistance to the poor and reducing poverty, were introduced or expanded. As of today, many of those programs have been in existence for more than 50 years. On the surface, it's reasonable to expect that after 50 years of anti-poverty programs, we would see a decline in the national poverty rate. A second factor that may deepen the mystery of why poverty rates have remained close to their 1960s level relates to the performance of the broader U.S. economy over the same time, decades of economic growth. This chart shows poverty rates for a variety of different age groups, with the overall and non-elderly poverty rates indicated here. The figure also shows, in blue, the trends in per capita growth in real gross domestic product over the same period. Recall that real GDP per capita measures the value, inflation adjusted, per person of all goods and services produced in the U.S. economy, and is often used as a measure of the standard of living. This figure shows that real GDP per capita nearly doubled between 1967 and 2012. As the standard of living has increased so dramatically, it is surprising that poverty rates have not declined. Our economic intuition suggests that economic growth should push poverty rates down. As we begin to think about why poverty rates have stayed so constant, it's useful to think about poverty on a more micro or individual level. After all, the poverty rate is simply the aggregation of individual poverty experiences. What do we know about what moves individuals or families into or out of poverty in a given year? Research shows that transitions from poor to not poor, or the reverse, are relatively evenly divided among 3 broad causes. First, changes in family structure, primarily moving between having a single-parent household to being in a 2-parent household and vice versa, often change a household's poverty status. Second, many leave poverty when they have a substantial increase in earnings, often coinciding with an increase in hours of work or a change from non-employment to employment. Third, increases in other income, such as income from transfer programs or non-work-related sources of support, can be critical to moving people out of poverty. These points are very simple, almost circular. Of course, income has to rise or family size has to change to alter a family's poverty status. Still, this helps us focus on 3 factors that do a lot to explain the pattern of the U.S. poverty rate over time. First, let's consider the role of family structure and changes in family structure over time in driving overall poverty rates. As shown here, the poverty rate for families headed by a single mother was 31% in 2014, compared to a poverty rate of just 6% among 2-parent families. There has been a very dramatic increase in the percentage of individuals residing in single-parent households in the U.S. since the 1960s. The overall poverty rate can be expressed by multiplying the fraction in a given household type, such as single-parent families, by the poverty rate for that household type, and summing over all household types. This table shows us these 2 elements of the poverty rate for a decomposition of the U.S. poverty rate at 2 points in time, 1967 and 2003. We can use these percentages and poverty rates by household or family type to show how such a decomposition of the overall poverty rate works. To arrive at the overall poverty rate for 2003, we simply multiply each number in the column labeled 1 by the poverty rate for the column labeled 2 and add up those products. This produces the overall poverty rate in that year of 12.8%. Even more usefully, however, we can also use this approach to calculate a counterfactual poverty rate for 2003 that shows what the overall poverty rate would have looked like if only the distribution of the household or family type had changed since 1967. This is done by using the fraction in each household type from 2003, but poverty rates from 1967. This will answer an important question. What would the overall poverty rate have been if only family structure changes had occurred, but poverty rates for each family type had remained at their 1967 level? To calculate this counterfactual poverty rate, multiply the fraction in each household type from 2003, the column labeled 1, by the percent poor in each household type from 1967, the column now labeled 3, and add them up. This gives an answer of 0.169, or the implied poverty rate would be approximately 17%. So one reason why the poverty rate has not fallen since the 1960s is that the dramatic changes in family structure alone should have caused an increase in poverty of nearly 4 percentage points. The fact that we did not see such an increase suggests that other factors likely counteracted the upward pressure on poverty rates due to family structure changes. Two such other factors already mentioned are economic growth and safety net or welfare programs. Next, let's look at the relationship between poverty rates, economic growth, and the labor market. I said earlier that it's surprising to see the poverty rate unchanged over the same period that we've had many years of a strong economy and substantial GDP growth. To examine this more closely, let's look at a statistical analysis of how poverty rates are related to the strength of the economy and the strength of labor market performance. This chart shows the statistical relationship between the poverty rate for small groups of U.S. states, called divisions, and several indicators of economic and labor market health over more than 3 decades. This is based on regression analysis that relates the poverty rate in a geographic division and year to a set of indicators of the division-level economic and labor market health. For our purposes here, you should keep in mind that a positive coefficient in this table means that the poverty rate will go in the same direction as the listed factor. For example, when the unemployment rate goes up, the poverty rate goes up. A negative coefficient means the poverty rate moves in the opposite direction. For example, as the median wage rises, poverty rates are expected to fall. The first key economic factor that predicts the poverty rate is the unemployment rate, which is frequently used as a proxy for the overall health of the economy of the country or of a state or division. As expected, the coefficient here on the unemployment rate is positive and is statistically significant. This simply means that in times of high unemployment or a weak economy, poverty rates are pushed higher. As we hinted at earlier, a strong economy is likely to reduce the number of individuals in poverty, not only because more of them are working, but also because earnings among those working tend to rise during good economic times. Thus, this analysis also includes measures of the level of wages, starting with the median wage. The second row of the table shows a negative coefficient, which means that as median wage increases, poverty rates move in the opposite direction or go down. This again shows the connection between overall labor market strength and poverty rates. The median wage, however, may not be the most relevant labor market indicator for those on the verge of poverty, who are likely to earn substantially less than the median wage level. Thus, the analysis also includes a measure of inequality, specifically the ratio of the median to the 20th percentile wage. This variable measures the extent to which median wages are further away from the bottom of the distribution, so that higher values indicate greater inequality in the lower half of the wage distribution. Here we see the expected positive coefficient, suggesting that for areas and years with greater inequality, and holding all else constant, if the 20th percentile of wages is further away from the median, poverty rates will tend to be higher. All of this demonstrates that measures of the economy and labor market are important predictors of the poverty rate, but so is inequality. What does all of this tell us about why poverty rates have remained relatively high? Recall, Even during past decades of economic growth, we have also had rising inequality and declining or stagnant wages near the bottom of the wage distribution. This analysis tells us that low wage growth at the bottom will predict that there may be little improvement in poverty, even with strong economic growth. Thus, the claim that it is surprising to see poverty rates remain high during periods of economic growth needs to be modified slightly. A low unemployment rate does improve poverty, but if periods of economic growth are also, as they were during much of the past several decades, periods of declining or stagnant wages, that is consistent with a lack of improvement in national poverty rates. This figure makes this point in a different way. The solid blue line shows the evolution of actual poverty rates in the U.S. We can use the statistical analysis we've just reviewed to predict how poverty would have evolved since 1980, based on the unemployment rate and wage measure coefficients estimated in that analysis. This prediction is given by the purple line with square markers, which corresponds very closely to the actual poverty rate. What this says is that our intuition that economic growth over several decades should have pushed poverty rates down was not quite correct. What is true is that this economic growth, accompanied by low growth in wage levels, together actually predict the lack of progress against poverty that we've seen. Finally, this also provides an opportunity to consider a connection between economic and labor market factors and the changes in family structure and the role of women in the economy that we talked about earlier. The final factor included in this regression analysis of the poverty rate was the fraction of women who are employed, and it has a negative coefficient. This says that as more women are employed, poverty rates are pushed lower. This makes sense if you recall the high probability that families headed by a single mother will be poor. An economy in which more women are employed reduces the poverty rate, partially by reducing the rate among employed single mothers. If we return to our predicted poverty rates based on this analysis, we can see the implication of this final point about female employment. The bottom dashed blue line shows how the prediction about poverty rates changes if we also include the rate of women's labor force participation as part of the prediction. Once we do this, the predicted rate is somewhat below the actual poverty rate over time. This says that the movement of more women into the labor force and employment predicted a small decline in poverty rates. The fact that we did not see that decline likely relates to the first issue we considered, the fact that more and more of these female earners were heading households in which they were the only earning adult, which of course tended to push poverty back up. To summarize what we've covered in this module, first, the presence of 2 adults in any household makes it easier for families in the U.S. to avoid poverty. As a result, we saw that dramatic increases in the number of single-parent families in the U.S. over time, holding all else constant, should have pushed poverty rates up substantially. Second, overall economic conditions are also a strong predictor of poverty. Strong economic growth, often proxied by low unemployment rates, does lead to lower poverty. Since the 1980s, however, economic growth in the U.S. has been accompanied by falling or stagnant wages in the bottom of the wage distribution, and this has worked to keep poverty rates relatively steady. In the next module, we'll consider the role of welfare or safety net programs.